Hey, good afternoon. My name is Randy Price. We are the Price Group, and welcome to our April 26th webinar. This is our quarterly market update. We'll go over things that are going on in the various financial markets, attempt to answer some of your questions, and give you some perspective and feedback on how we see things here from the Price Group. Goal is about 35 minutes. If you have some questions, type those in, and we'll try to get to those at the end of the session. Who are we? We are a fiduciary. Retirement is our main line of consult with clients. We sit down with folks on a regular basis. Again, I'm Randy, and Matt Price is always also here joining us, and we'll be talking about things that affect you with regards to your financial and your retirement planning.
So this will be review for the clients that are on the call. Randy and I both are certified financial planners, both went to Wharton School of Business to obtain our CIMA, Certified Investment Management Analyst designation. You probably saw the email last week. Randy was named once again for 2023 as one of the top Forbes advisors in the state. So we're really proud of that. I think that's the 5th time in the past 6 years. So Steward Partners, our firm based off the biblical definition of stewardship. We're not owned by a bank. We think that's really important in this type of environment. Raymond James has been our primary custodian. Custodian, just a fancy word for where client assets are held. We now have options of a few different custodians, Pershing, Goldman Sachs, more to be announced later this year, but for the vast majority of our clients, Raymond James has been a great fit, and we intend to keep it that way, assuming clients continue to be satisfied.
Okay, here we go with some of the pertinent information. The U.S. economy continues to do okay. Resilient is the word many people have used. Consumer spending is deaccelerating, but the sales, which look at over 9,000 stores, showed that the rate of decline has slowed, and we're at a pace about where we were last summer. According to some credit card data, the trends, people are spending more on necessities, food, auto parts, so on and so forth, and a slowing in some of the more discretionary spending like travel and entertainment. So again, we're seeing the effects of some higher interest rates, et cetera, but it is not nearly as bad as some had anticipated. But is the consumer getting tired? Well, the consumer following COVID was saving a lot of money, and with higher fuel prices, with higher interest rates, et cetera, consumers are saving less than they have historically, and with that, their ability to carry debt levels is decreased also. So debt levels are on the rise. Debt is more expensive. You've got a floating rate loan. If you've got a credit card loan, if you're getting a house loan, you're seeing that obviously what the Federal Reserve has done and the expectation of interest rates have caused interest rates to move higher, and credit is also harder to obtain. That makes sense. The banks, the financial institutions, as the possibility of an economic slowdown and job layoffs occur, they're going to be a little bit more careful and who they extend credit to or increase credit to those that are already customers. And job creation is likely to slow. A little bit of inconsistency here between the official data and real-time data. You can see there July through January, there was a contraction in some jobs. What's interesting is that even some of the big tech companies were laying off people. Amazon said they would lay off some people. Microsoft laid off some people, et cetera. Google parent Alphabet. And so this is the first time that a lot of these big companies have not been in just a pedal to the metal type hiring mode. And so job creation is likely to stall as the increases in interest rates work their way through the economy. Again, let's review what the Federal Reserve is trying to do is get rid of inflation, and to get rid of inflation, they're trying to slow the economy so that goods and services are by definition going to be more expensive. We've seen job postings on Indeed. They're a big drop of those as they move lower. Not widespread layoffs. In fact, the decline in jobs is very mild, but historically there are job layoffs during a recession or the expectation of a recession. We're only expecting the economy to lose about 500,000 jobs here. So again, mild from a standpoint of what some people have expected.
And to kind of look at the forest opposed to the trees, one thing I would add would be that the consumer still makes up about 2/3 of the economy. So as the consumer goes, so will the economy. That's how it's been historically for decades. And so if and when the consumer does slow down, there obviously will be ripple effects throughout pretty much any industry. But like Randy said, our expectation is for a mild recession opposed to a deep recession. And most all humans, including Randy and myself, were linear thinkers. And what I mean by that is the recent past sometimes informs what we think will happen in the future. So when we think of a recession, what have the last few recessions been? 2020 during COVID, you can put an asterisk by that one since it was so brief, even though it was by definition a deep recession. Or if we go back further, 2008, 2009, the financial crisis, or before that, 2000, 2001, 2002. So that 2002, the 2008, those are what we would consider a deep recession. But we think any recession that could form later this year will be mild in comparison to the most recent 3 recessions on hand.
And Matt, the interesting thing about a recession, if someone didn't tell us, for most people, especially in a mild recession, you would never know. It's those, like you pointed out, it's those severe recessions that we all remember more than the mild ones.
Yeah, absolutely. And we wrote actually today another blog post kind of discussing this in more detail. So hopefully we'll send that out here in the next few days if clients are interested in some more granular details on this topic. But expectations for a mild recession, when we look back at history, the average recession has lasted about 12 months. And we're saying, you can see here our chart on the right, our forecast would be the 3rd and the 4th quarter of this year with the economy recovering early part of next year. But like Randy said, a lot of people really don't notice a mild recession. If we look back into the mid-90s being the most recent, what we would consider mild recession on hand. So we'll talk about a little bit more, but the market is a forward-looking entity. And what that means is that clients will tell us, hey, I'm going to wait until the quote-unquote dust settles before we jump back into the market. But once the dust settles, typically the market has already made a move higher. So the market actually will start to bottom prior to the bottom for the economy or in the midst of the recession. And so monetary policy, a fancy way of saying what the Federal Reserve is doing and thinking. Take a look here at the chart on the left. This is the most aggressive tightening cycle since the 1980s. You can see that Mr. Powell and his fellow constituents have been very aggressive in how they have raised interest rates. Right now, the what they call the Fed funds rate is right around 5%. Our expectation is that there's a 1 more quarter% interest rate or a 0.25% increase in the interest rates. And then from there, the Federal Reserve levels off and has no more increases after that. So we'll see. Their next meeting is coming up here in just a couple of weeks on if that holds true or not, but that is what most everyone is expecting. And the good news for how the Federal Reserve, their number one goal has been to fight inflation. And in our humble opinion, they've made great progress with that. So the inflation numbers, there's 100 different ways to skin a cat, but most of them would agree that inflation is somewhere in the 4 to the 5% range currently. And that is well below the highs of 8 to 9% end of last summer, early last fall. Our year-end target is between that 3 and 4%. And you can see here on the left, there are a lot of things working to support that idea. Egg prices have been going lower for about 2 to 3 months. Lumber prices are way down. Oil prices obviously have been moving lower, and freight prices have been moving lower now for a number of months. So overall, we don't think we're out of the woods yet, but great progress has been made on reducing inflation. And if interest rates are lower, that is a catalyst for stocks and also bonds, which we'll talk about in more detail.
Okay, if you think so far has been pretty boring and some statistics, I think this is some of the better information and more pertinent and more helpful. What's interesting is we look back, we can see with exact vision what the Fed has done, when they've done it, and how it's worked out. And historically, the Fed, because they're looking sort of in the rearview mirror as they go, they raise interest rates to slow the economy, to get rid of inflation. And there is a delay in what they do to filter through the economy. So they tend to raise interest rate until the sort of the economy stalls, if you will, something breaks, if you will, and then they've gone too far. Then typically, as the economy slows, they'll have to cut interest rates to go back in the other direction. So you may have heard the terms hard landing or soft landing. The Fed is looking for a soft landing. They want to slow the economy down, be as, if you will, soft as they can with regards to that. And they don't want the economy just to hit a brick wall and just collapse. So again, with regards to this, interest rates right now on the short term are really high. Our money market that we're using is could get close right at 5% if the Fed raises one more time. But this cycle, we've seen this movie before, and it does have repercussions on how we might invest more cash if a client has too much cash. And again, realize that the Fed typically is in a tightening cycle, and then they go into the where they will start going the other direction. And I think we're somewhat close to that, unless something out of the wild blue happens that really surprises the Fed and causes them to want to continue that interest rate raising cycle. So as you might have expected, housing is somewhat weak in perspective. We've got the lowest mortgage applications in 25 plus years. You know, they were giving money away, looking back in retrospect, at a 2.5%, 15, 30-year mortgage. And now they're much higher. We're seeing the housing prices tick lower, but we started from a higher point. And so, you know, it's catch-22. Housing prices are down, but the consumer's ability to buy the same level of house are down also, because the difference between a 2 or 3% interest rate and a 6% interest rate are remarkably different. So again, the Federal Reserve has put the brakes on the housing by some of the higher interest rates. We are seeing some stress in the banking sector. Obviously, we had just a recent event where a bank in California that was poorly managed, poor lending standards, and didn't invest their money really well, actually didn't end well for them. But in our opinion, this is not the great financial crisis like 2008. where you had some excess leverage, speculation, poor lending standards, and a lot of derivative investments. But the banks that have had a problem so far have been specific banks that really hadn't followed sort of sophomore year finance courses on how to invest. You don't invest long term, especially when interest rates are low, when your deposits could go higher. And so the Federal Reserve, as you can see the chart there on the left, started hiking there in March 22, and they've gone higher. You see the SVB collapse penciled in there. And again, some of the regional banks have had a tougher time of it because of the worry if they were going to make it. But the Federal Reserve has made it clear they want to backstop and support banks. But again, here we are, not a 2008 type banking crisis, but there has been some issues.
One of our things that we discussed on our last webinar toward the first part of this year, we thought bonds were going to have a good year. That was one of our main bullet points, and yields continue to be attractive for a lot of bonds across different type of bond sectors. But yields are not pricing in a growth slowdown. And if we look back at history, yields tend to correlate with inflation. So if we did see inflation continue to move lower, it would be not really a far-fetched expectation that interest rates and bond yields also would move lower, which bring you back to kind of your childhood playground. You remember interest rates and bond prices, works like a seesaw. Interest rates going down pushes the bond prices up. So it would be some I'd say wind at the back if that were to happen. And the 10-year U.S. government bond still attractive on a yield perspective when we compare it to the dividends that a lot of stocks are producing.
And Matt, one more thing on the bonds. What's really interesting, I think, for the average person who really just looks at interest rates when maybe they get a mortgage, the 1-year Treasury bond is about 4.7. Okay, so what? Well, the 30-year Treasury bond is about 3.7. So we typically see long-term interest rates higher than short-term interest rates, but that's not the case, and we call that an inverted yield curve.
This is, I think, my favorite slide that we're looking at today. It's a look at the light blue is the tightening cycle. And let's look at the chart on the left first. The light blue is the tightening cycle for the past 12 to 18 months. And the dark blue is the average of the last 6 tightening cycles. So take more of a holistic look at it. And what we can see, if you look at the last 6 tightening cycles, is that interest rates have historically started to roll over or move lower 12 months after the tightening began. And so we're right at that 12-month period. Don't know if it's tomorrow, next week, or next month, but history does suggest that interest rates should move lower after that 12 months of tightening. Obviously, history, this is not something that guarantees rates move lower, but we like to say history does not repeat itself, but it does often rhyme. So our base case into the year, that 10-year U.S. government bond somewhere around 3% is our best guess as of right now.
By the way, the 10-year Treasury is right at 3.5% right now, so that would constitute a big move over the next 6 to 8 months.
Decelerating inflation is a positive for both stocks and also bonds. We kind of alluded to that on the bond side in the previous slides, but here with stocks, if inflation and interest rates are lower, more people will be interested in owning something that could potentially move higher, like a stock. So lower inflation does expand what a stock could or should be worth. And here, the chart on the left, performance following the easing inflation environment, you can see has been positive 80% of the time, 12 months after that the easing did start.
So as we was just saying, historically, the end of the tightening cycle typically is positive, is supportive of an equity market rally. You can see there on the left what that looks like. And then all sectors follow positive on the final Fed rate hike. 75% of the time, equity performance following the final rate hike is positive. And again, with regards to people worried that we are in a really bad economic time, all things are possible, but typically don't fight the Fed when rates are going up. And then when the Fed starts to lower rates, that's typically a good sign. And the market typically bottoms near or before the recession is called. The interesting thing here is that we are looking forward if we do get a recession, because historically, by the time that the recession is declared, it will be more than halfway through. Again, the market is looking forward. We think big picture, the market is already priced in the recession when it was down 20–25% at its low. And again, we're expecting a mild recession. Remember the statistics. On average, even during a bull market, the market is down about 10% once every year, and once every 3 years, it's down about 20%. So you see the 1980 recession, the 81 recession, the 1990, the 2001, the 2008, the great financial recession, if you will, and then the 2020 from COVID, which, as Matt pointed out, was a little bit different animal. But there you have it, history with painting a picture. And earnings should remain, for the corporate earnings, should remain somewhat resilient. Again, our expectations are a mild recession. And why do we expect earnings to hold up? We can see the 5 reasons there on the right. We don't think there's a collapse in sales. We think that there could be some sales growth year over year. Above average margins are expected to continue through the year. Supply chain has been an issue, a problem, and some of the easing commodity and labor costs. And then a weaker dollar. The dollar was on a real tear last year. So far this year has been down, but a weaker dollar should help and support some higher earnings as we're better able to export. And if you're a multinational company, that should help your earnings as well. So anyway, earnings we don't think are going to fall off the edge of the cliff.
And Randy, something interesting to note, a lot of these tailwinds or supporting pieces of evidence that earnings will not roll over were headwinds last year. So last year we had a really strong dollar. We had a ton of issues last year with the supply chains, and there were in a number of different industries what some would consider excessive headcounts at these companies. So these headwinds last year have turned into tailwinds, which we think is, like Randy said, a positive.
Time is on our side, an end of the bear market. There's a question mark there. Post World War II, the stock market is defined by the S&P 500 has not experienced 2 positive quarters without getting out of bear market. So again, there's history, 2007, 2009, and going backwards. Those are the bear markets that have lasted more than 2 quarters. And you got the green positive and the red as negative.
So we think there are some favorable trends happening under our nose. Look here on the right first. The 3rd year of a presidential cycle has historically been strong when compared to the 1st, 2nd, and 4th year of that cycle. And 94% of the time, equities have seen positive forward performance in the 9 months following a 7% or greater first quarter. So first quarter was up just right around 7%. That historically has led to more gains later on for the last 3 quarters of the year, which is not necessarily something that has to do with the fundamentals but it is something that has happened a number of times when we look back over the past couple of decades. And here, time, like Randy said, is on our side. This is kind of the second part of that. The duration of a bear market just being bad, which, by the way, I've been doing this with Randy for 13 years, and I've always thought, where do they come up with the bear and the bull? And I just recently learned the answer. A bear is swiping down with his paw, where a bull will attack with his horns going up. So that's free, no cost or charge for that interesting but quite possibly useless information. But the duration of bear markets is kind of coming in line with what is quote unquote normal. And then here on the right, you can see returns following a bear market have been robust. Like we mentioned earlier, the markets are forward looking. And so what they're doing is they're factoring in what we think is going to happen over the next 3, 6, 9, 12 months into the future. Had a conversation with a client just a few weeks ago when we were putting these slides together, and he'd been a client for a while, maybe 8, 9, 10 years. And he said, as long as I've known you guys, you've preferred the US over international stocks. And I kind of thought about it, and he was right. We have favored US stocks now for about 15, maybe 20 years, closer to 15 years probably. And here is why. You look over since 2008, US stocks, their average earnings growth was about 7%. And if you look at Europe's average earning growth for the same time period, it was between 2 and 3%. So when we take a step back, and there's short-term noise that can make stocks move higher or lower. If we take a step back though and look over the longer term, earnings are really what are going to drive stocks higher or lower. And so we continue to believe that US companies are going to be able to grow their earnings quicker than their international counterparts for a handful of reasons. But at some point, we're going to change our tune. And at some point, there will be a reversion to the mean, and we will favor international over US. But as of right now, we continue with the US over international theme. And here's our last slide before we kind of review our investment process. Change is inevitable. And what we did was we just picked out certain companies that at one point were in the S&P 500, the largest 500 stocks within the US universe. And some of these companies are no longer in business. Look at Radio Shack, look at New York Times, look at Sears, JCPenney, Bed Bath & Beyond, which got some horrible news. They're going to be shutting all stores. That came out over the weekend. Foot Locker, TripAdvisor, and the list goes on. Our point in putting this in here is diversification, we think, is a key part to being successful up until, but also through retirement. So a buy and hold strategy, we think, is sometimes taken out of context. We think it is good to buy and hold good dividend paying stocks, but that does not mean that you need to buy a basket of stocks, not look at them, not worry about them, and just hold them forever, because time is changing, and we don't know what the S&P will look like in the next 20 years. But part of our process is to look for companies that not only pay dividends, but historically have increased those dividends year over year. So Randy, talk to us a little bit about our Live Well plan.
Yeah, we've been called a little bit cheesy for calling it Live Well, but at the end of the day, our clients want to live well. So we think if a plan is not written down, it's not a real plan. And we think of this as a retirement roadmap. How much can we spend during retirement? Will my money last? Probably the most often asked question. And can I spend a little bit more and still not run out of money? Also, what should my investment portfolio look like? I'd like to have income. I'd like to get some inflation protection. So increasing income over time. and also I need to protect my principal. So a guy named Benjamin Graham, who has been very famous in some of the financial circles, said the best way to measure your success is not by whether you're beating the market, but whether you've put in place a financial plan and a behavioral discipline that's likely to get you where you want to go. And so this is the number one goal with what we do, is to sit down and make sure that we have a live well plan created. It gives a probability of success. And we look at every spending decision and every asset allocation decision based on what the averages will tell us. And our goal is for the clients to have clarity. Clarity will lead to confidence, and if they have confidence, it leads to comfort, and comfort is what a good retirement is all about. So your family index number, what rate of return do you need? Not just trying to take a lot of risk to outperform some index, but how do you get there with the least amount of risk? So this is a personalized measurement we use to define and track the progress of your portfolio. For our clients, you know this, as we sit down and go through our reviews on a regular basis, we show a chart, a graph, that shows whether you're above the line or below the line. We're replacing complexity with clarity, helping you understand, your family understand the rate of return you need to earn over a market cycle. And we're looking at your needs. We're looking at reducing the stress of trying to outperform a volatile stock or a volatile bond market. So it's clearly a tool to again, clarity, comfort, and confidence. We talk a lot about investment process. Is it repeatable? Does it work? Matt, you mentioned we use dividend stocks. We think that's one of our secret sauces. But if you're getting income and you're getting raises from companies that have a propensity to increase their dividend income, you get automatic built-in raises. We want to have an investment process because it's been proved that during periods of stress where the market does not do well, part of your brain that deals with logic actually does not work as well. So we think discipline, we think income generation are great core principles. Again, for a process-driven investment strategy. It's not just I think, I hope, but there's reasons, there's facts, there's statistics, there's confidence level on everything that we do with regards to that. And we want to preserve client assets and also generate income and growth to help folks enjoy, meet their objectives with confidence.
Here's our best picture. You know, a picture says 1,000 words to try to illustrate what it looks like to invest without an investment process. And the grayish line there is the S&P 500, or the overall stock market. And the blue, they kind of look like skyscrapers when they're going up, or holes in the ground when they're going down. Those are the fund flows of mutual funds and ETFs. So you're able to track when money is coming in or out of the market. You know, you can see at the end of 2002, after 3 years of having negative performance in the stock market, that along with end of 2008, early 2009, were the two most extreme selling periods on record, dating back to 1996, of selling stocks. So selling at the exact wrong time. When stocks were on sale, when you should have been adding to the portfolio, this was when a majority of people were not a majority of people, but the people in the most magnitude were selling stocks. So we think this is a great example of why we think we need to have an investment process, because we can promise things will get choppy. Markets are not going to go up every year. And at some point, portfolio values will be down. What are we going to do in that type of environment? And a good segue to that, in that type of environment, when there is a choppy type of environment, we think dividend stocks make even more sense. Here's a look dating back since 1930. And dividends account for about 40% of the total return. So just under half of your return has come from dividends dating back to 1930. We think that's a material number. And we are looking for companies, like we said earlier, that not only pay dividends, but historically have increased those dividends year over year. And there's a lot of supporting evidence to that. Dividend stocks, they're great multi-generational planning tools, which allow the older generation to live off the income while attempting to still maintain the buying power for the younger generation, if that is a goal. So we've created a Live Well plan for quite a few of you on the call. We haven't. Randy likes to pretend he's an old Baptist pastor. Comfort, confidence, and clarity are our goals when doing this. And we'd be happy to create or update that plan for you.
Matthew, how about questions?
I've had just a few roll in here. The first one has to do with, I'll try to rephrase it here a little, has to do with inflation. And I think what the client's getting at, the notion, if inflation gets back to where it was, will prices come back down to where they were? How about you take that one?
Sure. Obviously, inflation is a problem. 6% inflation doubles the cost of living in 12 years. So if you'd maintain that, it's really it can be really detrimental, and that's why increasing income is important. But to answer the question, it's going to be, unless you see some of the energy prices, some of the the big price cost for companies are energy and people. Unless you see some of the people prices and the energy prices come back down, we think the rate of growth is going to slow. But I don't think that you get a wholesale reduction in back to where we were, just because once that genie is out of the bottle, it's hard to put back in. But we do feel like the rate of increase will slow. And again, energy would be the wild card, because so much of that is dependent upon how much it costs to do your car, to heat your house, to bring goods to market.
I'll take the next one here. Do you have a recommended level of cash to retain in an investment portfolio right now? I would say it's a little bit more of a personal answer on, are there any big ticket items coming up? New property, new car, new motorcycle, anything like that. We look at the world, not necessarily how much cash to keep on hand versus how much income can we generate. And if the income generation from dividends, from bond interest, any other investments are meeting your needs, well, cash is going to be a little less necessary. However, if you own more growth-oriented stocks, keeping some extra cash on hand could be something worthy of consideration. Randy mentioned earlier, cash yields are just shy of 5% currently. So right now, the cash feels nice, warm, and cuddly, and kind of like that your favorite blanket that you sit by with the fire. But at some point, and we think it is not necessarily in the next few months, but we do think it's in the next 12-ish months or so, those cash yields will start coming lower. And when that happens, usually stocks have already made a turn higher. So we do think if you do have cash on the sidelines, it's not a close your eyes and put all your money to work at once. Typically, we'll recommend dollar cost averaging in over a number of months, but all depends on kind of how many stocks you already own and personal goals and objectives.
And Matt, if someone isn't a client, they may wonder where we're seeing this 5% yields on cash. As a fiduciary, we have bypassed our custodian's standard money market, which is in the 0.1%, 0.2%, which is what most of the major banks are paying. And we've gone around to an institutional money market fund. It's a manual transaction for us, but it works very well. We get a big kick out of helping clients make some money. And so many of our clients have transferred in cash from the bank, cash from the credit union, et cetera. And we're often asked, well, what's the catch? Well, the catch is you're one day delayed from your money. So anyway, we've had a big time of this, and certainly have put some money in the bank, no pun intended, for our clients to eat out a little bit more often, take an extra vacation, et cetera. So that concludes our remarks. We really appreciate you being here. Feel free to reach out, email, telephone to us. That's Maddie Kearns, Tiffany, myself, Matt, and Melissa. And we are the Price Group. Everyone needs a wealth coach. Hope to see you next time on one of our upcoming webinars. Thanks so much.